Welcome to the deep dive. Today, we are really zeroing in on the financial and strategic playbook of On Holding AG, that's ticker ONON. And specifically, we're looking at their Q3 2025 earnings call. Our mission is, well, pretty simple. We're going to shortcut straight to the CFO, Martin Hoffmann, to see how that premium brand vision is actually translating into hard numbers.
Exactly. And for anyone listening who wants that high-value information, fast, Hoffmann's remarks are really a masterclass in execution. We're going to look past the headlines to see how they keep that hyper-premium position while growing so quickly.
Right. So we're unpacking the Q3 results, the structural drivers, and the really aggressive raise to their long-term outlook. This is all about execution.
It really is.
Yeah.
I mean, the fact that they consistently deliver these kinds of numbers is remarkable. But like Hoffmann said, it's not luck.
Yeah.
It's a direct result of just intense operational discipline. That's the engine.
Okay, let's unpack this then. Starting with that core idea. The CFO's vision is to be the, quote, most premium global sportswear brand.
Yeah.
But, my question for you has to be, isn't that vision also a constraint? How do you grow at 30% a year without, flooding the market?
Well, that's the tightrope they seem to be walking perfectly. Hoffmann connects that idea of premiumness directly to performance and consistency.
How so?
It's about always exceeding what your fans expect, not just selling more units. And the clearest proof that it's working is just the incredible momentum they have globally, especially in the Asia-Pacific region.
The APAC data it feels almost unbelievable. I mean, the growth there is triple digit.
It is. The CFO was talking about a recent visit to Tokyo and how the brand just fits so well with that culture of craftsmanship.
Yeah.
And that cultural fit is, well, it's turning into record-breaking sales.
Okay.
We're talking about their new flagship store in Ginza. In October, it had the highest monthly sales across their entire global retail fleet.
The highest in the whole world. So the stores aren't just stores, they're brand statements.
Precisely. And it's not just in a mature market like Japan. They opened their first store in Bangkok, and on its first day, it had the highest daily sales of any store opening ever.
Wow.
It just confirms this global appetite for what they're doing. It's accelerating.
And that flawless execution, as they call it, flows right into the headline Q3 numbers. Let's dive into those. What were the specific top and bottom line figures the CFO was highlighting?
It was just massive financial acceleration. Net sales hit 794.4 million Swiss francs.
Which is what in terms of growth?
That's a 34.5% growth rate at constant currency. But I mean, more importantly, the profitability was just outstanding. Adjusted EBITDA growth of nearly 50% year over year.
That kind of margin expansion tells you they're not just selling more, they're selling smarter, more efficiently. What structural improvements did he point to?
It all boils down to operational excellence and technology. They've structurally cut their lead times, they've improved their integrated planning, and crucially, they are using more and more AI.
AI in what capacity?
Mostly in predictive inventory management and optimizing logistics. And that feeds directly into those shorter lead times and cuts waste.
Okay, let's talk channels. They have this balanced strategy, right, between direct-to-consumer, DTC, and wholesale. How did that breakdown look?
DTC is still the star when it comes to profitability. It was up 37.5% at constant currency, bringing in about 315 million Swiss francs.
And the strategic takeaway there?
The key insight is that omnichannel customers, so people who shop both online and in-store, deliver and I'm quoting here, materially higher customer lifetime value.
So the physical stores are basically data hubs for generating high-value customers. That makes the upfront cost look like a smart investment.
Exactly. And on the other side, wholesale was also really strong. It hit almost 480 million Swiss francs, up 32.5%.
And the CFO mentioned a strong order book, not just for next year, but for 2026. That seems incredibly far out.
It is, and he presented it as a huge vote of confidence from their partners.
I'd say so.
That kind of visibility lets them lock in manufacturing, manage costs, and basically de-risk their growth forecast 2 years out. It's a powerful signal.
Okay, here's where it gets really interesting for me. The Americas. Because that's where they ran the ultimate stress test on their brand. They raised prices.
Yeah, this is the key. The Americas grew 21% constant currency. But the critical point is that they put through price increases in the U.S. and demand stayed incredibly strong.
So no pushback from the consumer.
None. It means they're insulated from all the discounting pressure that's hitting their competitors. That premium price point is defensive. It's sticky.
That gives them some serious leverage. What about the other regions?
EMEA had an outstanding quarter, up 33% constant currency. The UK in particular has become one of their largest global markets, but really we have to go back to APAC.
The phenomenal growth. Give me that number again.
It really is phenomenal. APAC net sales, 144.9 million Swiss francs. That's up an incredible 109.2% in constant currency.
109%. That's not just selling more shoes. That's like doubling your entire operation in a year.
Absolutely. And it means APAC is now almost 20% of their total sales. It's gone from being a new market to a core growth engine.
Okay, that regional balance is a huge strength. And all that growth feeds the bottom line, which brings us to that, truly staggering gross profit margin of 65.7%.
Yeah.
It was way ahead of expectations. But Hoffmann was quick to point out some temporary tailwinds. So let's talk about apparel first, because I know that's linked, and then break down that margin.
Good idea. So Hoffmann sees apparel as a company within the company. It's not just an add-on. And its sales were up an amazing 100.2% constant currency.
So apparel sales doubled too, and they hit a big milestone, right?
They did. They sold over 1 million apparel units in a single quarter for the very first time.
So why is apparel so important strategically, beyond just the revenue?
Because it's changing who their customer is. The CFO said it's a key acquisition channel. It's bringing in first-time customers and, crucially, younger customers.
And they stick around.
They stick around, they buy more often, and they eventually cross over into footwear, which just cements that long-term value.
Okay, so now let's get to that 65.7% gross margin. It's so high, we really need to understand the temporary boosts. What were they?
So the CFO laid out 3 main temporary benefits. First, there was a positive one-time adjustment of about 200 basis points.
In plain English.
In plain English, they got a one-time bonus because shipping and freight costs in the first half of the year ended up being cheaper than they had planned for.
Okay, number 2.
Second was a timing lag. They raised prices in the U.S., but the full impact of some additional U.S. tariffs hadn't hit them yet, so they got the benefit of the higher price without the full new costs.
Got it. And the third?
The third was a currency tailwind, about 100 basis points because the U.S. dollar got a bit weaker against the Swiss franc.
So let me just summarize this for you listening. If I cut through all the basis points, the story is they got about a 300 basis point or a 3% margin boost this quarter from, well, good timing and a bit of luck on costs.
Right. That's a good way to put it.
But the crucial question is, even after you strip all that away, is the underlying margin still way above their long-term goal?
And that is the key takeaway. The CFO was very clear that, yes, even after you account for all of that, the underlying gross profit margin is significantly above their target.
And that's from the structural stuff, the D2C share, the AI.
Exactly. That's the real sustainable strength.
And that kind of margin performance, it just generates serious cash. Let's talk about the balance sheet, because that financial strength is what lets them raise their outlook so confidently.
Absolutely. Inventory was well managed at about 380 million Swiss francs, but the big number was operating cash flow. They generated over 157 million in Q3 alone.
Wow.
Which pushed their cash on hand to an incredibly strong 961.8 million Swiss francs.
Nearly $1 billion in cash. That gives them immense strategic flexibility. So if we connect this to the bigger picture, what did the CFO announce for the updated 2025 guidance?
They raised guidance on all 9 items. That's a rare show of confidence. The new constant currency sales growth is now 34%, up from at least 31%.
Yep, which implies they'll hit nearly 3 billion Swiss francs in sales. Gross profit margin is now guided to around 62.5%, and the adjusted EBITDA margin is now above 18%.
Those are major steps up. What does this mean looking further out to 2026?
It means they're crushing their original 3-year goals. So they updated their 3-year growth rate, their KR, from 2023 through 2026 to at least 30%.
Which implies, what? At least 23% growth in 2026 alone on top of all this?
Correct. And the final point the CFO made is that this year's higher gross profit gives them a stronger baseline to beat their 2026 margin target too, even with the full hit from tariffs next year.
So a powerful roadmap. The main takeaway for me is clear. This disciplined focus on being premium, combined with real structural improvements from AI to supply chain, is the engine driving everything.
Absolutely. Their commitment to selling at full price while everyone else is discounting is fully funded by those efficiencies and that pricing power. They're playing the long game for brand equity, not short-term sales. And this all raises an important question. And that question is, given the CFO's commitment to using AI and new tech to elevate the brand, and knowing omnichannel customers are so much more valuable, what does the next flagship store opening look like? What kind of new hyper-personalized experience are they going to deliver in a physical store to justify that exceptional premium margin? Something for you to think about as you step away from this deep dive.
Thank you for joining us.
We'll catch you on the next deep dive.